Good afternoon. I am Lorraine Salvo, Head of Financial Planning for Palisade Capital. As your moderator, I'd like to first thank you for taking the time to join us today. Dan Veru, our Chief Investment Officer, will speak for about 20 to 25 minutes. If you would like to submit a question, please click the Q&A button at the bottom of your screen, type in your question, and hit send. If you are on the call and for any reason are not able to access the visual presentation, please continue to listen in. For your convenience, a recording of this webinar will also be made available. Following the presentation, Dan will answer as many questions as time allows. Before I hand the reins over to Dan, please bear with me as I read a brief disclaimer. The information contained in this webcast reflects the view of Palisade Capital Management, LLC and its affiliates as of the date of broadcast. These views are subject to change without notice at any time subsequent to the date of broadcast. All information provided in this webcast is for information purposes only and should not be deemed as investment advice or recommendation to purchase or sell any specific security. You should consult your financial advisor regarding your personal situation before making any financial planning or investment decisions. While the information presented herein is believed to be reliable, no assurance, representation, or warranty is made concerning the accuracy of data presented. In addition, there can be no guarantee that any projection, forecast, or opinion in this webcast will be realized. Certain information included in this webcast has been obtained from third-party sources believed to be reliable. No assurances can be given that such information is accurate. Past performance is not a guarantee of future results. With that said, Dan, you have the floor.
Thank you, Lorraine, and welcome everybody to what I hope will be the first of many opportunities I have to speak with you all. Happy New Year to you all, and thank you very much for your business and entrusting Palisade with your assets with us. Today, I'd like to talk about a couple of different important topics that frame what we think is going to be the progression for the markets as we go through this year. I'll get to the bottom line. I expect it to be another good year for stocks. I think that it will be a year where returns are in the low teens for equity investors. I do not think it'll be as good as it was in 2019, but nonetheless a very solid year. For bond investors, I think it's going to be a little bit more difficult, mainly because where I see some of the excesses is actually in the bond market, not necessarily in the stock market. And we're going to talk more about that later on. Stock selection this year is going to be perhaps more important than it's been in many, many years. And I'll talk about why, what frames my view on that. I think the U.S. is going to lead yet again in stock market returns, but I also think that international stocks will do considerably better after many years of sort of being on the sidelines. And while I expect large stocks to do well, I also think small cap stocks, which lagged last year, should do considerably better. I want to first start by talking about the recent events in the Middle East, namely the attack in Iran, because it's very important. I was working on my update prior to that event happening, and it really hasn't changed my view on what equities are going to do for the coming year or what the economy is going to do as well. What would change that? Clearly, if this was a prelude to war, where we were escalating tensions and getting ready to send troops and equipment over to the Middle East, that uncertainty is never good for stocks if you look at previous escalations prior to an invasion. So for now, I think that these events are somewhat isolated. The reaction in the crude oil market has been very muted. Crude has barely budged to the upside. And those are all very, very good things, as that's one of the areas where confidence can be eroded. So today, I'm going to give you my outlook on the markets, as I've started to talk about. But very important to that outlook is the direction of interest rates, and something that we don't talk a lot about, the shape of the yield curve. I'm also going to talk very briefly about corporate bond spreads, which is really how much a bond investor requires to make that bond attractive to that investor. I'm also going to talk about what's happening around the globe in terms of interest rates. And lastly, we'll talk about the US dollar and how important that is and how that factors into my thinking. So this slide is very important. I always try to use pictures when I can. This is the yield curve on the US Treasury bond. Essentially what this shows is what Treasury yields are starting from 1 month and going as far out as 30 years. The blue is where we were right at the end of the year, and the red is where we were 6 months ago. And you'll see there's a dramatic change in the shape of that curve. You may have heard in the financial media talks about an inverted yield curve, and really, what does that mean? Other than it's just a squiggly line on a piece of paper. An inverted yield curve historically has been conditions that could be a precursor to a recession, simply because it's indicative that the Federal Reserve is keeping their policies too tight. In other words, that interest rates are simply too high. And certainly the case could have been made earlier in the year, and certainly this time last year when markets were more in disarray, that certainly was the case. Interest rates were rising throughout 2018, and I believed and had made the case that the Federal Reserve was on a path to making a policy mistake and possibly really hurting growth by keeping money too tight for investors. Why is that important? Obviously, what the Federal Reserve does with interest rates affects everything. Consumer credit, how much your mortgage is going to cost, a variety of different factors, how much companies have to spend when they borrow money to expand. So it's an extraordinarily important measure, and those actions really impact the global economy and certainly the US economy. An amazing thing happened this time last year in January. The Federal Reserve, after raising interest rates many times during the course of 2018, made almost an about face and began to lower interest rates. Well, why did they do that? Why did they start to introduce that as a possibility? Simply put, the global trade tensions between the United States and China were really having an impact on confidence. You combine that with slowness in China itself and the reverberating effect of weak economic activity in China has a direct correlation to activity in Europe. And conditions in Europe were quite slow during the course of 2018 and into the middle part of 2019. And in a very rare move, the Federal Reserve reversed course and decided to begin lowering interest rates, acknowledging that these were having a significant effect on the US economy. As I said before, this was not just a US phenomenon. This was happening in Europe as well. I've made the case many times that if you want to understand what's going on in China, you need to look no further than what's going on with the German economy. And conditions in Germany were quite slow. That isn't a misprint on the chart that you're looking at. Interest rates are negative in Germany. And what does that really mean? Well, if you're making an investment in a government bond in Germany, you will get less money at the end of the maturity of that bond. That's how poor conditions are for risk appetite in Europe right now. Conditions were very slow, and the markets, the economy there really was at stall speed at this point. I think that the actions from the US really were extremely important in changing the shape of the yield curve in Germany as well. And you see now that that yield curve has steepened considerably. I also want to touch on the fact that the fourth quarter, and I should add as well, a similar dynamic, though perhaps not as pronounced in France as well, which has also struggled to grow for similar reasons. I want to point out that in the fourth quarter of 2019, we really had a tremendous amount of positive developments that are dramatically affecting the shape of all those yield curves I just showed you. First of all, we now have a framework for a phase one trade deal. And as of today, the Chinese have made their flight reservations and they're going to be flying over to the United States to sign that deal. That's extremely important for confidence. And it really is a mutual decision on the part of the leaders of both economies to make this deal happen. It's important for China. It's important for the United States. Secondly, and perhaps of lesser notice, was the trade deals between the United States and Canada and the United States and Mexico. Previously known as NAFTA, the trade deals that are now known as the USMCA were rapidly and overwhelmingly approved by the House of Representatives. And the latest information that I have is that the Senate will approve that early next week. This is a very, very positive news because that uncertainty and the importance of Mexico and Canada as part of our supply chain and the closeness of our economies in terms of the transportation of goods back and forth is extremely important, and any disruption there could have a material negative effect on our economy as well. So we've had some big events, and I'll throw on top of that the historic elections in the United Kingdom. And as many are well aware, the UK has been struggling to exit the European Union with the overwhelming re-election of Boris Johnson as the Prime Minister and the Conservatives taking over by a wide margin within Parliament. That almost assures a smooth exit and assures that that outcome is going to happen. Again, removing another uncertainty from the markets. I'd like to switch over and talk about the bond market here. And I don't want to get too technical here, but it's very important to note what happens in the bond market really influences what happens in the stock market. Currently, what I'm showing here is the spread, or how much return an investor is looking to get over a riskless bond instrument like a treasury bond. Well, the good news is they're not asking for very much right now because there's a high degree of confidence that the US economy is going to grow. I'm showing in the blue is the high yield bond, and in the darker blue, it's the high grade bond, but both pretty much follow similarly. That's great news for equity investors, but if you're a bond investor, the best thing you can hope to get is the coupon that you invested your money in. For years, because interest rates were dropping and spreads were tightening, you were getting some capital appreciation in your bonds as well. I don't think that's going to be what we're going to see for 2020 and beyond. And I actually believe that there are greater risks for bond investors than there are for equity investors. We've talked about the yield curve, and it's normal to have a steep yield curve in our economy. And the steeper it gets, the more conducive it is for investors to take on risk by buying stocks. So it tends to be a nice tailwind for stock investors. What I'm showing here is really looking backwards in time and showing that as the yield curve normalizes, like it's doing right now, that has a very positive impact on the S&P 500 going forward. And it's part of my case for why I would anticipate that stocks in the US will do better and stocks around the world will do better as well. Small cap stocks could also see a big benefit in this environment as well, as there is also a correlation between the shape of the yield curve and how well small cap stocks do. The US dollar is a real important point to talk about. And again, when we talk about the dollar, we're talking about it in relationship to the euro, the Chinese yuan, and other major currencies around the world. The US dollar has been a real pillar of strength, certainly over the last several years. There's been a lot more optimism about the US, and this has caused a lot of capital to flow into the United States. Some of that has been driven also by more favorable tax policies here, and companies abroad just looking to the United States as a better place to do business than they have historically. It's also, though, a measure on a relative basis of the weakness that has occurred both in Europe, China, and other parts of Asia as well. Saying it perhaps slightly differently, we were a very clean shirt in what was becoming a dirty laundry basket around the world. Now things are beginning to change, and I think that's also a positive for US stocks, a further incentive for companies and a further tailwind for certain companies, particularly those companies that export products around the world, what are commonly referred to as multinational type of companies. The US dollar is weakening, not because there are bad things happening in the United States, but because we're seeing the very early signs of recovery in many economies around the world, namely Europe, which has begun to come out of its long malaise, and China, which is going to benefit from a big uncertainty taken away in at least the phase one trade deal. I should also point out that current deal, as I see it, still has tariffs against a lot of goods coming in from China. Those tariffs are going to be reduced, and the president has the option to reduce them further, which in an election year could act as a tax cut for many people and might see more reduction in tariffs as the year progresses. So I'd like to summarize what I'm saying in 6 key bullet points. I think the economic growth that we've seen in the United States is beginning to go global. There's plenty of things to worry about, and I'll be watching very closely for Middle East tensions. Also, I should mention, too, the problems that Boeing certainly have an effect in perhaps modestly slowing the U.S. economy. So if that situation on the 737 MAX is resolved, that would certainly be another tailwind. But the economic growth that we've seen in the United States is beginning to go global. The Federal Reserve is not going to be in the way of stocks the way they were in 2018. I believe the Federal Reserve, at a minimum, will not look to raise interest rates till well into 2021, perhaps even beyond that. And what is an out of consensus view that I have and share with some other very prominent strategists is that we're not at the end of an economic cycle. I actually think we're closer to the middle of an economic cycle because we have none of the upward tensions that you normally see when the economy is ready to go into recession. Most recessions, as I've mentioned, are caused by a policy mistake or the Federal Reserve tightening money too much. That is not the case that we are in right now. Major currencies are beginning to challenge the US dollar dominance. That's not a negative on the US, but for a good reason. Other economies are beginning to do better. And I anticipate that that will put a bit of pressure on the US dollar. And again, for companies that export products around the globe, this is a positive because a weaker dollar makes those companies more competitive and their products more competitive on the global stage. The trade deals, you can't overemphasize that the trade deals remove a major impediment. And what really drives economic growth is confidence. And it's confidence at the consumer level. Consumers have to be confident about the future, but also corporate managers have to be confident because they are the very biggest allocators of capital. They need to know that there is a long-range plan so they can make long-range investments and buy equipment, build factories, do all the things that drive economic growth. That capital investment cycle started right when we made material changes to our tax policy, but then it was quickly eroded by the decision by the administration to essentially use tariffs as a means of improving trade relationships with China. My fifth point is that presidential elections by historical measures are very good for stocks. The average return is around 8% in an election year. We could see more, we could see perhaps a little bit less. My forecast would be for stocks to deliver in the low teens. And very simply put, the party in power wants to stay in power. So they will do what they can to keep the economy going, keep confidence up, to bolster their reelection prospects. And lastly, and perhaps the thing that I and my entire team here at Palisade are focused relentlessly on, the stocks you own will drive how you do. I think this year is going to be extremely important for stock pickers. And what I mean by that is because of some of the things I've talked about, has very important implications for where we allocate capital. Right now, financials are an area that we think are extremely important because that yield curve that I referred to, a steepening yield curve, is a more profitable environment for banks and other financials. So that's an area we've been invested in and will continue to be invested in as well. Industrials, because as our economy continues to grow, the cyclical aspects of industrial type companies become more attractive in that kind of a quote unquote risk on scenario. Healthcare, while it's a little bit more difficult to pick winners and losers, we think you have to pay attention to valuation and have valuation support within the healthcare space. And you have to be mindful of the political winds, given it's such a big driver, but we see a lot of opportunities within the healthcare space. Technology is also going to remain a very important driver of our economy and of the stock market. But again, we want to be very careful. There's a lot of pockets of excess valuation, meaning that the stocks are overpriced, particularly with many software companies. But there are other areas of the market that look much more attractive to us. And then lastly, we have more of a positive outlook on some material companies. We think the outlook for gold could be attractive on a going forward basis. It's been a good place to be since the middle of the year, and perhaps we think that will carry through into 2020 and perhaps beyond. So that's all my prepared remarks right now. I'm going to turn it back to Lorraine to ask any questions that you may have.
Thank you, Dan, for sharing these very important insights. For our webinar participants, again, if you would like to submit a question, please click the Q&A button at the bottom of your screen, type in your question, and hit send. Dan, we actually have received several questions already. Earlier, you touched on crude oil prices. What do you feel is the future of precious metals in 2020?
Well, I just touched on gold, but I think you could also make a positive case for silver, platinum, and then also some of the base metals like copper. Copper is obviously used in a lot of industrial applications. It's a good metal to get a sense for the pulse of economic activity. When you build a house, you got to use copper for the pipes or a building or what have you. So it's been in an uptrend more recently, and that also frames my more positive cyclical view on the economy. So I think those base metals will do well, as will precious metals.
Thank you. You mentioned several reasons today why U.S. stocks should continue to perform well on a go-forward basis. Notwithstanding these comments, do you feel that stock prices have become too elevated relative to future earnings?
This gets a lot of attention in the press that the price earnings multiple on the S&P 500 is 18 times right now. But remember, that's an average. There's a lot of inexpensive stocks within the index, and there's a lot of very expensive stocks in the index. I think valuation is going to be very important in 2020, and also the outlook for those companies. So that really supports my view that you really want to pick the right companies in the right sectors and be careful what you pay for them, because the overall index by historical means is expensive. But that doesn't mean that we can't find attractive companies with a good outlook within the context of an expensive benchmark. It actually might mean that if you're an intelligent stock picker, you can actually beat that benchmark because perhaps the benchmark struggles to go up significantly.
Thank you, Dan. It looks like that's all the questions we have for the moment and all the time we have for today. Thank you so much, Dan, for your thoughts today. Thank you to everyone on the line for joining us and for your confidence in us here at Palisade Capital Management. Feel free to follow up with us anytime with questions you may have, and have a wonderful rest of your day.
Thank you, everybody.